Thank you, John. As usual, come through in the clutch. Very excited to have Elaine Buckberg with us today. She's a senior fellow with the Salata Institute for Climate and Sustainability at Harvard. Previously, she was the chief economist for General Motors, where she was responsible for assessing the impact of worldwide economic developments and providing advice on various competitive and economic policy issues, as well as representing General Motors with senior U.S. and foreign government officials. So doing a lot of cool stuff. Prior to that, Dr. Buckberg served as Deputy Assistant Secretary for Policy Coordination with the U.S. Treasury Department, where she was leading role in fostering infrastructure investment, which is near and dear to our hearts here in Georgia. We've been benefiting very much from infrastructure investment the last few years, but certainly the last few decades. She also had stops as a consultant with the Brattle Group and NARA, Economic Consulting, as well as Morgan Stanley and the International Monetary Fund. She received her PhD at MIT, an undergraduate degree from Yale. Additionally, Elaine has been a longtime friend of NABE and is currently serves on the NABE board. Elaine?
Thank you, Mike. I'm delighted to be here today, and I want to thank the Atlanta Economics Club for inviting me here today to talk about EVs. And it's actually the club that picked this topic, but I liked it because we'll talk about the sustainability of the market, we'll talk about EVs and sustainability, as well as industrial policy, economic effects, and charging. We're going to have a quick tour of a wide range of issues about EVs. And to start with, we'll talk about the foundation, what's happening in the US EV market, and where it may be headed. And one of the lessons from my time at General Motors and all the market research that GM did is going back, even really before even going back 5 years or more, if you surveyed consumers whether or not they'd consider adopting an EV, the answer was yes, I just don't want to give up anything else. I still want it to be about the same price. Maybe the average consumer can conceptualize 1 or 2 years of ownership cost savings, but really can't do the full discounted cash flow. They want a lot of range. Even if 75% of new vehicle buyers own their own home and have dedicated parking, so they get to avoid the gas station the overwhelming part of the time, they want every vehicle in the household to be full usage. And again, even if they can charge at home, they want to know that charging is everywhere, it's easy. We might not be doing so well in that one yet. And then they still want the vehicle they want. So if they're a pickup, they want a pickup. If they want a third row to carry around a lot of passengers and a lot of stuff, they still want a third row. So you need to have a market that provides all those things. And the good news is that's coming as EVs become larger range, that there are a larger number of shapes and sizes. And as charging expands, EVs are becoming closer substitutes for internal combustion engine vehicles. I think that's one of the most important stories about the trajectory of the market in the future. But it is true that for the first time after a long upward trajectory, for the first time since 2020, EV sales dipped in the first quarter. So first of all, you probably late last year were reading news stories that said EV sales were slowing, but that was journalists having a little bit of difficulty between levels and rates of change, because late last year you were still up about 50% year over year in every quarter. So still very high class growth. First quarter dips a little bit. The EV share of sales is in the high 7% range. It's still the highest first quarter ever. So some challenges, but the trend's still up. And I think that this data comes from Cox, who I know is well represented in the room. And it's also clear from their data and others that a lot of the slowdown in the first quarter was disproportionately falling on Tesla, which still has about a 50% market share, while other automakers that are now offering a more robust set of competitive choices saw their sales up. I think one of the key things to keep in mind, though, about the long-term trajectory of the EV market is the drop in battery costs. The battery is the most expensive part of the vehicle, and it's continued compression in battery costs that have the potential to make EVs cost competitive with ICE or even less expensive. And so if we go all the way back to 2010, which isn't shown on the graph, it was over $1,000 per kilowatt hour of battery. If we look at 2023 here today, it's $139. And over this 10-year horizon, it's a 16% CAGR. If we look at the most recent 5 years, it did slow somewhat to about 8%. That's partly due to the cost of some of the embedded metals. But nonetheless, I am a true optimist on battery costs because there is a massive amount of research going on, public and private, around the world into batteries. One second. That research, I think, is likely to produce breakthroughs, not slow down. And when I say a massive amount of research, I want you to think Manhattan Project or COVID vaccines. And battery costs are very important because, again, it's key to the total cost of the vehicle, but also as battery costs are coming down, we're also seeing more energy density, which means that you can put more battery in any given unit of space. Yes, we have a question over there.
This is per pack.
Per pack. So
How many packs for the average vehicle?
Well, it's in general, you can think of the pack as what's going in. It's a number of cells that varies per vehicle.
Okay. So this is a...
But it's per kilowatt. This is per kilowatt. It's the price per kilowatt hour at the pack level.
So...
It's not price per pack.
Equivalent to per vehicle.
No, this is the cost per unit of energy. It's the cost per kilowatt.
Okay. And how many kilowatts does the average vehicle require?
I have to say I've never thought about things in those terms, so I can't.
Yes, I understand it depends on the vehicle, but I'm talking about an average.
I'm sorry, I just can't provide that. So perhaps someone else in the room can later. But
my Nissan Leaf is 87 kilowatts, 87.
And the Leaf is pretty small, so in terms of its battery, so that would suggest to me like total ballpark, but the average would probably be more like 200 today. The other thing is that range keeps improving, and the battery cost compression is critical to this, as well as the energy density, because you can fit more battery inside of a vehicle, right? One, it's more affordable, and two, it's just smaller, and so you can fit it in. So if we look at so if you want to go back to the late 2010s, 2018, 2019, you're still only getting 200 miles, not very acceptable to most vehicle owners. In general, they used to want 300, now they want 350, but the median EV in the US market now has 270 miles of range. And the Lucid, which is quite high-priced sedan, has over 500. But by the way, the Lucid, I understand, does not just have a whole bunch of batteries somehow embedded in a very low-profile sedan, but very efficient use of the same amount of battery, which again is a promise of where technology can go. How many people in the room own an EV? Show of hands. Not a lot. How many people have either driven an EV or ridden in one? A lot, right? So that's something that I feel like is a really important part of the story. And clearly in Atlanta or in this crowd, a lot of people have experienced EVs. Other parts of the country, perhaps not so much, right? But those EVs are not pokey. They have super fast acceleration. You better watch your speedometer. They're super nimble. They're really fun to drive. And as more people understand this, I think this will be conducive to acceleration in EV sales. And indeed, as more people understand it, the US market is very differentiated by region in terms of EV share of sales. And so the West Coast is the most advanced market, and California has about a quarter of its sales are EVs. The East Coast is pretty strong. Georgia's a little above the median in terms of the EV share of sales in that 10 to 15% range. But we basically have sort of regional advancement. And as more and more people, I think, become familiar, you may get acceleration in different parts of the country. But of course, we are still far behind China and Europe. So third quarter last year, we were at 8.1%. China was about 15%. I'm sorry, Europe around 15%. China actually approaching 30% EVs as a share of new vehicle sales. So the auto industry is very global. Every major automaker in the world is in at least 2 of those 3 markets. Regardless what attitudes are here, those markets will pull us farther forward. Moreover, there are very powerful regulatory incentives that compel automakers through the fuel economy and greenhouse gas standards to greatly increase the EV share of sales that will force that function under current policy. But even if there weren't, it would be hard with the global market, the other 2 biggest markets and most similar markets advancing at such a pace, for the US market not to be seeing overwhelmingly EV entries a few years from now. Any questions on that part? I'm happy to take a question or 2 at this stage. Okay, otherwise we'll keep going. And we'll talk about EVs and industrial policy. And at this point, there is a huge range of policies designed to support EV production, from production tax credits to the EV purchase tax credits, which is what I'll focus on today, to, again, those more stringent CAFE and greenhouse gas standards. And I think we'll take this up perhaps in the Q&A, but a big leak on Friday of potential 100% tariffs on Chinese EV entry. But to understand the policy and the new EV tax credit, I think it really helps to start with this graphic from the International Energy Agency, which is an international government-backed think tank. It looks at the four important battery metals: lithium, nickel, cobalt, and graphite, across different stages of production, as well as stages of battery production. Anything red on that graph is China. China's role in the global EV supply chain is objectively huge, especially in the processing phase. This is global supply, so the fact, given China is the largest auto market in the world by far, and the most advanced in EVs, it's not surprising that they're ahead in actual sales in EVs. The new clean vehicle tax credit has threefold goals. One is promoting EV adoption for climate benefits and reduction of emissions. Second is supporting growth of U.S. EV manufacturing, so the U.S. would remain a robust producer of autos and retain those jobs as the industry transitions. And the third is what I would call the Senator Manchin aspect: prevent U.S. EV manufacturing from being vulnerable to foreign control of supply chains, due to the picture I just showed you. But I think the real issue Senator Manchin had was, don't spend federal dollars to promote U.S. EV production if we would be vulnerable a step down the supply chain. And so what happened? So first of all, there was a pre-IRA EV tax credit that went back to 2008-9. And so it was $7,500 for any EV, except that once any given automaker hit 200,000 in sales, they phased out. So Tesla and GM had phased out in about 2019. And Ford and Nissan were on the cusp of it. The new tax credit extends it to 2032 for EVs that meet a whole bunch of criteria that I'll take you through. Half the money is for the composition of battery components, half for the composition of critical minerals. And then there's a separate credit for commercial purchases. So think the cable company or the landscaping company, but also leases, because a company owns a car that's leased to a consumer. And it also adds a tax credit for used EVs. And there are a variety of strict requirements that go on this. So let's focus on the middle column here, the consumer purchase tax credit. Again, $7,500, half on critical minerals, half on battery content. So it's a mix or match. Threshold requirement that the vehicles have to be assembled in North America. The percentages of critical minerals and battery components required to access those two credits increase each year, becoming increasingly stringent, but the hardest criteria at all. Zero content from foreign entities of concern, most importantly China, also Russia, North Korea, sponsors of terrorism. As of this year, there can be zero China content in the battery components, or the entire vehicle is ineligible for that credit. And as of next year, also zero content in critical minerals, which is actually much harder. There are also caps on the manufactured suggested retail price and the income of the buyer to screen out the use of federal dollars for either very luxurious vehicles or very high-income households. Oh, but look at the right-hand column. That's the commercial, 1 second, please. That's the commercial credit. What can be used for leases? None of those provisions apply. Yes?
When did these come into effect?
January of 2023. But then the thresholds increase every year. And so what happened? So before IRA, immediately before, there were, if I look at model years 22 and 23 that were in market in August of 2022, there were 26 models that were eligible for the EV tax credit. As soon as it goes into effect, the North American assembly provisions go into force, and it drops down to only 11. Then in January of 2023, all the other provisions start to go into effect. And you end up with 11 EVs that are eligible. At least one trim is eligible for it. And of those, only 7 are getting the full tax credit. But you could actually have a higher volume of EVs getting the credit because Tesla and GM get access again, at least for certain trims. And Tesla is running at right now around 50% of the market. So fewer models. Clearly the criteria are biting, except that you may be getting higher volumes. If I looked at it as of last week, in terms of model year 23 and 24, which what currently in market, we're up to 13. And indeed, that's up from earlier this year as a number of automakers have managed to, at least for certain trims and certain models, get their batteries to qualify. But clearly, the criteria are biting because those origin criteria and price criteria. The other thing is we're very clearly getting more domestic investment in the EV supply chain. And this graph is from a fantastic website maintained by Jay Turner of Wellesley College. And first of all, you can look at this graph and see on the map above tons of investments across the US with a big concentration in the Southeast as well as going up to the sort of traditional auto region in the northern Midwest. And then on the bottom, you see this timeline of investment announcements. So Jay tracks that since IRA passed, there are 100 new projects announced, bringing a claimed 56,000 new jobs and $87 billion investment. But look at the graph, the timeline on either side of that IRA line. You can see with your eye that the bars are higher on the right side, as it's brought more investment in. And then let's come back to that lease concept. Again, leases are exempt from all of those origin provisions, the price caps and the income caps. And I know this is a gnarly graph, but I promise to make it easy. So first of all, this is from research by Chad Bone, formerly of the Peterson Institute of International Economics, now actually at the State Department. All the dashed lines in the middle, that's the EV, that's the lease share of new vehicle sales on internal combustion engines. And if you look either side of that end 2022 line, no real change. They're pretty flat, right? The solid lines are the lease share of EVs by origin. Blue line at the bottom, those are North American made EVs. They ticked up some, a little bit. That yellow line, those are Korean EVs. So the EV share goes from, the lease share goes from about 0 to about 45% by early last year. And then the black line, those are European EVs. Lease share was down around 15% and is all the way up to about 70%. So clearly, automakers are offering more leases on these vehicles, trying to get them through the channel. They access the tax credit and pass some along to the consumers. So clearly a loophole that's having effect.
Dr. Buckberg, are you seeing advertising from OEMs around leasing for EVs? What do you feel like? Yeah, I mean, the credit's driving it, but are the manufacturers pushing it?
So it's a little hard to tell because, leases are often expressed in terms of the monthly payment. So it's hard to say how much is being passed through. So if the automaker is getting $7,500, it's hard to say how much they're sharing. I have seen some websites and advertising that suggests that. The high end of the market was traditionally, this is the luxury end of the market, tended to be a high lease end of the market, but that's clearly much higher. Now, automakers don't want to own all the vehicles they sell, right? When you lease a vehicle, you still own it. You're taking it back as a not very used vehicle and putting that in the market. It's taking up your balance sheet, so there are limits. But it looks to me like they are allocating that balance sheet towards high-end EVs, and also that all those European automakers and Korean automakers who need to meet a certain composition of their sales in terms of fuel economy and greenhouse gas that are really enabled by those EV sales, that they are pushing those EVs and trying to remain cost competitive. Now, what about emissions? Sometimes I see articles that say, or people who say, but what about the mining? Are they really green? Are they really good for in terms of emissions? The answer is yes. So this graph, which I will walk you through, is from a study led by Argonne National Labs with several other national labs and industry participants. And they look at EVs from the very inception of mining all the way through the scrappage of the vehicle. There are other studies that look more narrowly. And there are pairs of bars here, so look at the first bar in each pair. The current gasoline vehicle, 429 grams of CO2 per mile. Hybrid, big improvement, 312. EVs, regardless of the size of the battery, from 200 to 400, between 200 and about 250. Much better. When they project forward both changes in the composition of the grid as well as changes in the technology, the gas vehicle becomes 322. Hybrids, again, still an improvement at 255. EVs, 140 to 170. Much better, lower life cycle emissions, even after you control for the mining. So don't let anyone tell you otherwise. And then there are the economic effects. And I'm going to get my water for a second. Any questions right now before we move on?
A quick one. All the discussion now is about EV tire, burning through tires faster, and that tires are highly polluting in production. Did you see any discussion of that in that report that you were referencing?
So the Argonne report is super unfriendly, first of all. I don't recall it. I would say that discussion is happening in your environmental circles and is happening in circles where people are talking about sort of environmental equity issues, but that's not a big topic. I think that's a smaller issue.
Well, it seems to be the journalists. When you want to poke holes in EVs, that's the du jour.
Right, but again, that is an increase in one particular type of pollution effect, but not a emissions or climate effect. And I think that there are all these questions of, there are lots of environmental trade-offs in everything we do, but which matters more, emissions or other environmental issues at this moment? So So another thing I want to talk about is how the EV transition will improve the US economy's resilience by breaking the link between foreign geopolitical risks, oil prices, gas prices, and our economy, and reduce recession risk. And I think a lot of people in this room, like me, can actually remember the 1970s energy crises, when OPEC's boycott and supply controls drove gasoline prices up and oil prices and gasoline up just very vertically, you can see, and the economy entered recession. And there's actually research by Jim Hamilton of University of California in San Diego that says every post-World War II recession, with the exception of 1961, had rising oil prices a contributing factor. COVID is also an exception. So there's this link that historically also depended on the fact that we were big oil importers. Not so much anymore. And certainly you heard a lot in early 2022 about recession risk associated with those higher oil prices. Now, the US is actually the world's largest oil producer today, ahead of Saudi Arabia. And we are actually a small net exporter if you look at oil and oil products, which reduces the direct effect of higher oil prices on GDP. Even if basically every single driver or every household that owns a vehicle is feeling the impact of higher gasoline prices on GDP, someone in the US economy or certain parties in the US economy are also benefiting because that state is oil producing, it's an oil producing company, it's someone in that industry. Less well distributed benefits, but nonetheless that greatly reduces the direct effect of oil prices on GDP. But consumer sentiment remains tightly tied with gasoline prices. Now, compared to, say, the 1970s, vehicles are much more fuel efficient and much less of a household budget. Just a couple percent tends to go into their gas bill. But there's still this outside relationship to sentiment, perhaps because every time you buy gas, it's almost the only thing you're buying, and the price is on a really big sign. But not only can you see in this graph that University of Michigan Consumer Sentiment Index is on the vertical axis, and gas prices in inflation-adjusted terms, so not current prices, are on the horizontal axis. You can see that there's a strong statistical relationship or correlation between the two. But a number of researchers have written papers where they also control for a variety of other factors, and that relationship remains robust. And this is very important because consumer sentiment, when consumer sentiment falls in relation to higher gas prices, that means consumers tend to pull back. Consumption is 70% of the US economy nearly. So that means there's a real slowing in the economy that can arise when there's geopolitical risk that drives up gas prices. Of course, most recently burned in all our minds when Russia invaded Ukraine. EVs can help break that link. This is a graph of monthly average fueling costs, sort of hypothetically, for an EV owner and an internal combustion engine owner. In order to calculate this, I've used the same monthly average mileage, about 12,000 miles a year. I've used the average fuel economy of an internal combustion engine car and an EV, and national average gas and electricity prices. So first of all, you can see there's an enormous amount of volatility over time in this decade-long graph for the internal combustion engine blue line at the top, right? You're down to about $75 and all the way up to over $200. And then you can see that the BEV line is fairly straight, not very volatile, and substantially lower, with those costs hovering under and up to about $50 a month. Much lower, preventing households from being exposed to that volatility. I've also done this for 9 different states where I could get the gasoline and the electricity price data. I can't find a state in a month where it would have been more expensive to own an EV. And I think that, as more and more consumers hear from their friends and their neighbors about how much they save, that will also help people conceptualize those benefits and contemplate an EV purchase. So to wrap this section, EVs stabilize the economy by breaking the link with oil geopolitics and it reduce recession risk. So it takes out downside risk from the US economy. So we shift transportation energy demand from oil products to electricity. It reduces our entire energy price volatility. 2/3 of petroleum use in the US economy is transportation. And even on the right, our grid is renewables, nuclear, natural gas, and oil. Natural gas and coal. There's almost no oil. Those natural gas and coal prices, they have less volatility, and they're generally delinked from global prices, unlike oil, because there are some barriers to trading them. It breaks the link between gas prices, consumer sentiment, and consumption in GDP, and over time, there'll also be, EVs will be powered by increasingly renewable energy sources. And the last thing I want to talk about is charging. And range anxiety is a big deterrent for EV purchasers. And I want to talk now about the research I'm doing at Harvard, jointly with researchers from MIT. I want to give a shout out to Omar Asensio, who's visiting at Harvard Business School, but is from Georgia Tech. And charging problems get a lot of bad press, and I'm sure you've all read about it. And J.D. Power has actually done surveys of recent new vehicle buyers and asked, why didn't you buy an EV or consider an EV? Top 2 issues, price differential and concerns about charging. And again, charging is an issue. People want to feel like they can do a road trip in a vehicle, even if they rarely do road trips, even if they have another vehicle. They want to know that it has every use case. We also know from earlier research that public charging is critical, and my colleagues and co-authors have found that spending on charging stations is vastly more effective than spending on rebates at the margin, and that if you moved about 15% of the funds between the bipartisan infrastructure law and the IRA from rebates to charging, the EV share of sales in 2030 could rise by 20 percentage points from about 48% to 68%, with also a near doubling of CO2 abatement. So what do I mean by real-time data? So first of all, I mean that you can get information on whether a charger is working, whether it's available, and also how much it would cost to charge, ideally, in a central app, in Google, in Apple, in PlugShare, wherever. Because the worst nightmare of an EV driver is I try to take the thing on a road trip, I run out of charge, I get to a charger, it doesn't work, and I can't make it the next 30 miles or 50 miles to the next charger, and I need a really expensive tow. And by the way, EV chargers say, well, I have my proprietary app, but you can't cross-reference across apps while being a solo driver, can you? You need a navigator, or it's not safe. Charger uncertainty is also costly because drivers need to allow for search time on top of more time to charge. And drivers value they're getting gas at about $27 an hour. So we think that central real-time data can alleviate range anxiety by preventing failed charges. That you'd only go to chargers that worked and were available, and that you could improve the actual uptime by shining light on where there's downtime. And actually, Commissioner Tim Echols here asked me to make this slide for him for a recent presentation at UNC. But if you're a Tesla owner, you get to type your destination, that screen, and it routes you to their chargers, and it figures this all out. But if you're anyone else, it's way worse. So that Tesla was going down I-5. I-5 is the most mature EV corridor in the country. But if you're anyone else, if you go to PlugShare, it is the single best of breed. 2/3 of those chargers are in red. You can't get data on those. Or maybe you can't access them if they're Teslas right now. Only 1/3 can you get data on. So you really are in the dark about where you can charge. To give you a sense of how in your dark, look at this. We've taken 6 of the largest highways in the country, and we've looked at every charger within 2 miles of an exit, driving distance. If it's red, no real-time data is available. If it's green, it is. It's pretty red, right? And to dig down a little more, here's a table that looks at some of those. So here on I-95, it's pretty much exactly typical of the 6 highways. 33% of stations, think a gas station, have real-time data. If I take out Tesla, which until recently has only been open to its own drivers, then Electrify America, which is the other biggest network in the country and doesn't provide real-time data, I get to 63, but oh, whoops. I lost, well, I guess I-5. You lost 40% of the charges, is pretty typical. I-5 is the best of them all. 42% of stations have real-time data. I-90 is the worst, only 26. If I look at plugs, like the number of handles, it gets even worse. And then there are these things I call data deserts. And since we're in Georgia, I'd like you to focus on my favorite of them, which is across the Florida Panhandle, from Jacksonville to Daphne, Florida. 400 miles, 17 charging stations from 6 CP charging providers, no real-time data. So if you wanted to drive in an EV across the Panhandle, you'd have to do a lot of research before you drove in there, because unless you're in a Lucid, you need to charge along the way. And we also think that whether or not this real-time data becomes universal can drive good or bad outcomes. And I should have said that the NEVI program, or the programs funded by the bipartisan infrastructure law, require charging providers to put their real-time data on an API where any software developer can get it free. So Google would have it, Apple would have it, PlugShare would have it, the next killer app developer could access it and put it in a one-stop shop for you. But there's no requirement for any other charger. It's just what the charging providers choose to do. And a lot of them want to keep it in their proprietary app. But if real-time data became standard, it would drive improvement in uptime. So it would really shine light on who has down chargers. It would create a more competitive charging market, which is good for reliability, speed, and pricing. It would reduce uncertainty and lower those search costs, and therefore, I think, alleviate that uncertainty and accelerate EV sales. And this part is based on some extensive modeling that we expect to publish within the month. And that means a much bigger total addressable market for charging providers. In fact, based on our modeling, it means EV sales would be about 10 percentage points higher each year like this decade. Think 30% to 40%, or 50% to 60%. And that means 20% more registered EVs in this country each of those years, with a big reduction in emissions. But what if that doesn't happen? What if we just get stuck in this equilibrium and it's really hard to find a charger? Well, I think there's the real risk that EV adoption will slow or stall in a persistent way. And one of my co-authors, Chris Knittel, talks about that the diesel market, we never got into diesels in the US because the first diesels were crappy and no one wanted to try them after that. We don't want a diesel problem. There's also potential uncompetitive pricing outcomes bad for adoption if there's no requirement for disclosure. So when I went to the airport yesterday, normally about $30, Lyft said 37, Uber said 63. Wow. Imagine that EV chargers are like that, and that we've got a more mature market where EVs are actually being sold extensively into the used market. So a more price-sensitive customer. And they stop to charge in its triple pricing. What are the headlines then? And that used vehicle market is essential for the new vehicle sales. So let's wrap. The US EV market is growing and it's evolving rapidly, but I still think it's on a growing trend, even if we've roughly flattened for a few months. But China and Europe are far more mature markets, and that's gonna help pull us along. There's no two ways about it. Supply chains are really concentrated through China. The EV tax credit is designed to build a thriving domestic EV industry while reducing that dependence, and it looks like there's some new policy tools coming down the road for that. Don't let anyone tell you otherwise. EVs involve fewer emissions than gas-powered vehicles. In the long run, EVs can help improve economic resilience by reducing recession risk. And if we want to solve sales and lift EV sales faster, real-time data from chargers can alleviate range anxiety and speed EV adoption. Thank you. I'm happy to take more questions.
You know, you talked a little bit about it earlier, but there are some potential policy changes upcoming that are going to affect the EV market. You know, there's recent news saying the Biden administration is considering just 100% tariffs on Chinese imports. So I'd like to get your thoughts on that, or just any other kind of future legislation that you see coming. And I also asked, you know, should I be considering this kind of upcoming legislation in the context of like a potential administration change in the next election? What does that mean?
Yeah, there are probably some politics. So a big leak on Friday from the Biden administration saying that they would announce likely this week 100% tariffs on Chinese EVs imported from China. Currently, Chinese vehicles of all kinds face a 27.5% tariff versus 2.5% for most favored nations. I think the 100% tariff's pretty prohibitive, especially because then you'd have this additional wedge that you couldn't possibly access the up to 7,500 EV tax credit. So I think that would really pretty much quell Chinese imports. There are questions about how China could get around it. They could produce in the U.S., but then you have U.S. labor costs, so that's going to reduce their cost advantage massively. You could produce in Mexico, but you still need 40% high wage labor. And so I think and then of course, again, accessing the tax credit would be zero China content in the battery. I just don't think that's a very likely scenario. But here's the hard question. You've got two different policy objectives. You're trying to reduce emission for climate reasons. This administration definitely is. And you're trying to protect the U.S. auto industry and build a robust EV industry. By keeping those Chinese EVs out, you're slowing the cost reduction of EVs and therefore slowing sales compared to an alternative. So a really hard policy decision, I'd say, but I think that the Trump administration has not been warm to EVs, or the previous one in recent comments from former President Trump, but he's very comfortable with tariffs on Chinese goods. Commissioner
To your
Echols.
point, Dr. Buckberg, the cheap Chinese solar panels that we imported in 13, 14, 15 enabled Georgia to become 7th in the nation with solar because we had an avoided cost threshold for that solar, and the cheap solar panels allowed us to get under that. And we really took advantage of that here in Georgia.
Yeah, difficult policy trade-offs. I think I had some questions on this side of the room.
You talk about real-time data from chargers. Is it telling you whether or not it's open and working, or is it telling you how long the wait is to get up to use it, or how long it takes to charge? What is the data that you're...
Well, what the requirement is for the bipartisan infrastructure law chargers is it in service? Is it available? How much would it cost to start charging now? I think there can be variation around that and more or less data, but can you just find that information? Can you avoid going to a station where nothing will work? That's the number one.
Well, it seems to me another really critical piece of information is there's a charger and it's open and it's working. How many people are lined up to use it? You know, you can show up and there's 10 people in line ahead of you.
Well, that's where the available, not available. I think these standards will evolve, but the requirement, I mean, I think the easiest thing to do is mirror an existing requirement, and that's it's real-time status, which I translate to, is it working, number one? Is it available, number two? And it does require the price. It's worth saying that California has issued draft regulations that will require the same for the chargers that either the state or ratepayers help fund. And they would require that update to the status within 1 minute.
Just a couple of comments. There are all apps already with charge. I'm just speaking here in Georgia with ChargePoint, and if you have Apple CarPlay, you can plug in, and it has a map, and it shows the chargers, the cost, and if they're available.
Yes, but all my statistics are off.
I'm saying just for Georgia.
Right. Well,
the other comment I want to make about
okay.
EVs, is that the Detroit car makers and their auto dealerships do not want to sell EVs. And the reason I say they do not want to sell EVs is the maintenance and service on the cars, which is negligible, and maintenance and service is a big profit center for those dealerships. So it's against their interest to actually sell you an electric car. And if you go around and talk to the dealerships that have electric cars, they normally have salespeople that are completely ignorant on how electric cars work,
Right.
charge, et cetera.
Yeah, thanks for raising those points. So actually, all the data I showed you on the availability of real-time data on chargers is off plugshare.com, which is an EV-specific site, but we've tested on multiple different occasions. It has substantially more data than Google Maps does, and vastly more data than Apple Maps. And so when you look in Apple Maps, it's telling you that information for some chargers, but not all in the state. And the thing is that you want to be able to have that information for all, especially when you're on a highway road trip and in an area you don't know. I think I agree with the problems with dealers, and I agree that many have not done a good job at getting their salespeople to understand EVs or want to sell them. I think that there's evolving. It's true that you don't need to take your EV in as often, but it's not true that you don't at all. And there's lots of systems like cooling systems and other systems that are quite sophisticated in the EV, and those will need a different kind of maintenance than the internal combustion. It doesn't need an oil change.
On the Nissan Leaf, the first generation of it, for 8 years, and it had no maintenance. That's kind of hacked over.
Yeah, but
The first major maintenance on that car would have been at 125,000 miles.
well, that is very unusual compared to other EVs. So let's just leave it there. Yeah, perhaps you did, but they have very low range. So we have a question over there, then we'll go over there, and then we'll keep going. Okay.
I'm curious about, is the charger infrastructure there to when you do open it up, right? I have Tesla. I like the benefit of being able to go to a Tesla-only charger, get the supercharger, and go to the next one. And I know, and they have the availability, they have everything there. But when you start opening it up to everybody else, right? And I'm actually in that anxiety about range anxiety that comes into existence. I would have that if it's open to everybody too, right? So that adds another layer of anxiety for me that, maybe it's not there before, but now it's there. When I'm opening up the network. So how does that
So Tesla has to open about 7,500 of its, I think, about 17,000 chargers to all EVs by the end of the year in order to access tax credits under IRA. In addition, they've made agreements to open other chargers to selected automakers who are paying them for access. So that's, I think, more like 12,000 if I recall correctly. There is a lot of additional charger rollout going on. So is the supply of charging exactly keeping up with the expected future stock of EVs, year to year? I think that's a little hard to assess because we don't have good forecasts of charger rollout. We do have the bipartisan infrastructure law, chargers just starting to come online, which will help with those highway corridors. And we could have a whole other topic about Tesla firing all 500 staff who worked on supercharger build out, and then now saying on Friday that perhaps there's still going to be lots of supercharger build out, and Tesla has a lot of contracts with states under the bipartisan infrastructure law. So that's a pretty murky area right now. Over there, I know you've been waiting.
Yeah, so on the real-time data point,
and I know we're over time.
Is there a sense of whether it's really uncertainty about whether the charger is working or available or price? I mean, I don't have real-time data on gas prices or gas pumps working, and I'm not worried about the pump not working. Like, why is there no incentive to make the chargers always ensure the chargers are always working?
It's just really challenging right now. First of all, the gas station technology is less sophisticated. Two, the gas station is attended. Most of these charging stations are not attended currently. So no one knows to fix them. They don't apparently send useful or reliable signals back. And if they do send a signal, sometimes they say they're working when someone's run over the handle or there's a wasp nest inside that's presenting it to worry. And apparently when they do send a signal saying they're not working, they don't sort of signal what kind of technician they need. It's a suite of different problems, but we think that until you get that actual improvement in uptime, the data at least would alleviate that range anxiety. And